Hello, everybody. Welcome to our webinar. We're really excited to have you here, and thank you so much for spending an hour with us as we help navigate, guide, and understand what is going on with California's mandatory climate disclosure laws. We'll get into this as we go through this presentation, but just as a caveat, as I'm sure many of you know, this is an ongoing process. So we are doing our best job to collect all the information that we have from all of the sources we have available to synthesize it in a way that's easy to digest and easy to navigate for all of you listening. All right, so here we have a wonderful group of people with us today. My name is Lauren. I'm with Carbonhound. And we have Susan Spencer and Lisa Foster as well. They are the co-founders of Blue Sky Climate Reporting Services, a California-based firm that helps companies navigate their climate reporting requirements. So for companies that they don't assist with,
yeah. So sorry, I think we're actually having a problem with LinkedIn. I think it's connected to your account. So I think you have to log in again, because it's not appearing on LinkedIn right now.
Okay, yeah, I'm seeing that we are streaming on LinkedIn Live. So if people are watching in the comments, maybe just give us a thumbs up or a hello. And here, let me just, I'll send you the link as well.
Okay, thanks.
Okay, well, hopefully people out there can hear and see us. And we'll just go ahead and we will be sending out this recording as well as the slides after the fact. So yeah, back to Blue Sky Climate Reporting. They provide independent third-party assurance to verify greenhouse gas emissions claims under laws like this new California Climate Disclosure Act. And actually, before we get started with the meat and potatoes of this, we would love to do a little poll for everybody in the audience. All right, so here's this poll that we'd have going out. Yunji, if you just want to go to the slide with the QR code so people who are watching can scan that and have a quick look. We really want to get an understanding of how familiar you are with those new mandatory corporate climate disclosure laws, so SB 253 and 261. So you can actually just join using this QR code here, or we'll leave the link in the comments on LinkedIn. And then, yeah, kind of have a little think and let us know where you're at. All right, we'll give people a couple more minutes and we'll compile the answers and address some of that towards the end to get kind of an understanding of where people are at. But hopefully throughout this process, you'll get a little bit more familiar and start to understand where we're at with these reporting requirements. All right, I'm going to pass it off now to Susan and Lisa.
I'll take it from here, Lauren. Thanks so much. It's great to be here with you today. We've got a lot of information to cover, but before we jump in, it's important to mention that we'll be providing information today based on past updates from CARB. So that's the agency in charge of rolling out these new California climate laws. CARB stands, just for your information, as California Air Resources Board. And you'll see during our presentation today that we're expecting more updates and clarifications from them in the months to come. We strongly encourage companies to subscribe directly to CARB, and you're also welcome to either reach out to Carbonhound or to Blue Sky Climate if you'd like to receive our updates regarding updates from CARB. So, okay, with that said, let's take a few minutes to review the background of California's new climate laws. California has always been a leader in environmental policy, and in 2023, it became the first state to pass a set of climate disclosure laws known as the California Climate Accountability Package. This package included 3 bills: SB 253 for greenhouse gas emissions reporting, SB 261 for climate-related risk disclosure, and AB 1305 for carbon offset claims. Governor Newsom signed them into law in October 2023, while also raising concerns about cost and timing. Since then, SB 253 and 261 have faced legal challenges, and lawmakers responded by introducing a new bill, SB 219, to preserve their intent while addressing those challenges. Meanwhile, AB 1305 was revised and reintroduced as AB 2331. So in short, I know that's a lot, but these laws are in place and they're evolving, and companies should be preparing now. And that's what today's session will focus on: what these changes mean for your business and how to get ready. Next slide, please. Great, thank you. So today's focus: SB 261, greenhouse gas emissions disclosure, and SB 253, climate-related financial risk disclosure. As a high-level overview, these are the first mandatory climate reporting laws in the US. They affect companies based in and doing business in California over a certain financial threshold, which we'll discuss on the next slide and throughout the presentation, actually. On a CARB update call last week, the agency announced that it was implementing mandatory annual submission fees. So this is new to folks. And that's going to, in principle, cover the cost of the program. So while they're still finalizing the amounts for the fees, here's an estimated breakdown, again, that they shared with us last week. So for SB 253, the GHG emissions reporting law, the estimated fee is about $3,106 to be precise, as per their comments. And for SB 261, the climate risk disclosure law, the estimated fee for submission is about $1,403 per year. And if your company has more than $1 billion in annual revenue, you'll be required to pay both fees, as you'll need to submit, of course, both reports. So CARB has said that these amounts will be finalized and communicated in December, but this gives us a really good indication of what companies should expect. Last point here is about the 2026 deadlines. The deadlines for reporting are January 1st, 2026 for SB 261, which is in statute and confirmed. For SB 253, the date proposed by CARB is tentatively June 30th, 2026, bearing in mind that it's not yet in statute. Okay, so next slide, please. Before we get into the specifics of both Senate bills, I'd like to begin with who needs to comply with this legislation. That's the big question. So CARB is still finalizing this, but in last week's call, they indicated that reporting companies will be defined as those, and I feel like I want to use air quotes here, but doing business in California. How do they define that? How do they define those who are doing business in California? First and foremost, by annual revenue. If your company has annual revenues in excess of 500 million, you may be required to disclose your climate-related financial risks under 261, SB 261. If your company has annual revenues in excess of $1 billion, you may also be required to disclose your greenhouse gas emissions under SB 253. Think of this as the first gatepost. Okay, so from there, CARB is potentially looking at the California State Revenue and Tax Code 23101 for further definition of who's in scope. If they do use the tax code, and that's still a question that they'll need to answer, they are considering annual revenue thresholds and any one of the following criteria. So sales in California, over $735,000 per year, noting that this figure includes sales through agents or contractors. Payroll in California, over $73,500, and property in California of $73,500 and above. And of course, are legally headquartered in California. So that falls under that definition. So in terms of exemptions, CARB has shared guidance with the word being here that likely exemptions, that they'll be extending exemptions to nonprofits, government agencies, and companies whose only footprint in California is remote workers. They've also proposed an alternative approach for this definition, which may take into account the use of existing databases of US-based companies to establish doing business in California. Lastly, we know that CARB is still working through its definition. We talked about that a second ago, and they are accepting public comments. So if you would like to have your voice heard, we encourage you to go ahead and submit your comment for them. In short, this is not yet set in stone. We officially, or we need to sit tight for the official definition, and we'll be watching that very closely in the months to come. Okay, next slide, please. So this is about parent companies and subsidiaries. So we did learn a little bit more about that as well last week. The guidance from CARB is that if a parent company and its subsidiaries together exceed the annual revenue threshold and they meet the doing business in California test, the parent company can file one report covering all entities. Subsidiaries only need to file separately if they individually exceed the threshold and the parent does not consolidate reporting. CARB is encouraging one report per corporate family to avoid duplicate filings. Although we're still awaiting CARB's final confirmation, the working assumption is that if your company meets the thresholds, even without a physical office or formal operation in California, you should expect to report under one or both of these new laws coming into effect next year. Okay, next slide. So let's look at these two new California climate disclosure laws, SB 261 and SB 253, and how they apply. So first, SB 261, climate-related risk reporting. So again, we might have touched upon this, but it's really important to do a deep dive into these points. First, this law applies to companies with over $500 million in annual revenue doing business in California. Under SB 261, companies are required to disclose their climate-related financial risks, both physical risks like extreme weather events and transition risks like policy or market changes. These disclosures must be reported to the state and also published on the company's website. Importantly, SB 261 is aligned with TCFD and IFRS S2, so companies can lean on those global frameworks they may already be familiar with. The reporting is primarily qualitative, but, and this is crucial, if a company makes specific climate or emissions reduction claims, those must be third-party verified under Clause 5 of the law. We're getting a number of companies reaching out to us right now to ask us about this, and really it is important to note that even though obtaining assurance for SB 251 isn't front and center within the law, it is indeed there, and companies are now needing to obtain third-party verification, again, of their publicly disclosed claims. We'll talk more about assurance in just a few minutes. So leaving that and moving over to SB 253, greenhouse gas emissions disclosures. This one applies, of course, to larger companies, so those with over $1 billion in annual revenue doing business in California. It's focused on greenhouse gas emissions reporting. For the first compliance cycle, so those reports due in 2026, companies need only disclose Scope 1 and 2 emissions, but starting in 2027, they're going to need to submit Scope 3 emissions as well. So that's the supply chain and customer use side. These inventories must be prepared in line with the GHG protocol, which is the global standard for emissions accounting. Third-party assurance is required under this law, and we'll discuss, as I mentioned, more about assurance in a few minutes. So, in summary, SB 261 focuses on climate-related financial risks and disclosures, while SB 253 requires greenhouse gas emissions reporting with third-party assurance disclosures. Together, these laws establish a new baseline for climate reporting in California, one that CARB estimates can apply to up to 10,000 companies. Okay, and next slide, please. So penalties for noncompliance. Let's have a look at what happens if a company that is in scope for these laws does not report. For SB 261, climate risk reporting, penalties can be up to $50,000 per company per year. And for SB 253 GHG emissions reporting, penalties can be up to 500,000 per company per year. So CARB has emphasized a good faith effort. We just need to talk about this for a quick second. So any of those companies that are making a good faith effort in their initial 2026 reporting, and it shows that they are really wanting to demonstrate that they're making progress, they're getting organized, they're starting their disclosures and building capacities, rather than really expecting perfection. CARB is going to be looking at that and considering that as well. So the takeaway here is the state is serious, the penalties are real, but if you demonstrate a genuine effort to comply with the stated regulations, the state will take that into consideration. And next slide. Okay, so let's take a closer look at SB 253 and how it's going to be phased in. For the first submission due June 30th, 2026, companies will be required to report their 2025 Scope 1 and Scope 2 emissions. Then, starting in 2027, companies will also need to include Scope 3 emissions, those indirect emissions across the supply chain and product use. And I just want to ask, we have someone typing, so if we can just hold on for a quick second. Thanks so much. This means that companies should already be thinking about how to map and collect Scope 3 data now, even if it isn't required in the very first year. So CARB has also set clear rules for assurance. Scope 1 and Scope 2 will require limited assurance starting in 2026. By 2030, reasonable assurance will be required, a more rigorous level of verification. And for Scope 3, limited assurance will be required by 2030. A few important logistics. The CARB reporting portal will be open December 1st, 2025, and will close on June 30th, 2026. That's obviously the deadline. Draft reporting templates will be available by September 30th, 2025 to help companies prepare. And importantly, disclosures must be submitted annually for SB 253. They must also be made available for public access through the CARB portal and posted on the company's website. Finally, companies are expected to retain detailed records to support their disclosures and the assurance process. So good documentation practices will be essential. So in short, SB 253 begins with Scope 1 and 2, but quickly expands to Scope 3. And over time, the assurance requirements will also get more rigorous. Thank you for your patience. That's a lot. With that, I'm going to turn the mic over to Lauren to talk about GHG emissions.
Thank you so much, Lisa. So what we're going to do now is we're going to take a look at greenhouse gas emissions and how they relate to reporting against SB 253. To measure your greenhouse gas emissions, there's a protocol called the Greenhouse Gas Protocol that outlines a way that a business should go about understanding their carbon emissions. And they divided emissions into 3 scopes. And what each scope is looks at a different part of your business and how your business is creating impact. So scope 1 relates to your direct emissions. So in your physical buildings, what are the things that you own that create emissions? So if you own a fleet of vehicles, for example, what are the emissions that are associated with the gas that you buy to run that fleet? Your scope 2 emissions are your indirect emissions, but they still have to do with what you can control within your business. And that is actually really just your purchased electricity and your heating and cooling. So you can't control how the electricity is made, but you can control how much you use of that electricity. The third piece is your scope 3 emissions, and this comes from your organization's value chain. So what we're going to do is we're going to have a look at everything that you purchase as an organization, things that come in and out of your facility, how people come to and from work, and there are 15 categories that are outlined as part of your scope 3 emissions. For most businesses, this is where a ton of your emissions, the vast majority of your emissions are actually going to come from. And it's definitely the most complicated part of understanding your company's emissions, but it's definitely where a lot of the impact lies. So now that we know a little bit about what goes into measuring your emissions, let's talk about how to actually do that. There's lots of different ways you can approach this in terms of doing it yourself in-house, hiring consultants to support with this, or leveraging software like Carbonhound. At Carbonhound, our approach is to understand how your business operates, identify what the different sources are, data sources are, that are going to be material to your carbon footprint, aligned to the greenhouse gas protocol, and then apply this measurement, this way of measuring that is, again, outlined by the greenhouse gas protocol to get you to a carbon dioxide equivalent, or CO2e, or carbon footprint. So we're going to take your business data and multiply it by an emission factor. So examples of your business data would be utility bills, for example. So I used X kilowatt hours last month. It might be how many kilograms of grains you purchased last month or last year. It might be how many kilometers you traveled and by what method, in what plane, to get to that conference that you have to go to. So we're going to take all of that raw data, and then we're going to multiply that raw data by an emission factor. And those are sourced from scientific studies, third-party sources that have done calculations on what the equivalent CO2e would be for that type of raw data. So once you put those two things together, you get your carbon dioxide equivalent for that particular data source, and you do that across your entire business. Where you don't have real data, usage data, such as kilograms of ingredients or kilowatt hours, we're going to use spend-based emissions, which is a slightly lower quality way of measuring your emissions. But we can say, okay, instead of how much product did you use in terms of weight, what is the amount that you spent on that product, and then use a spend-based emission factor to get to your carbon dioxide equivalent. Once that's all done, of course, we're going to have the reports, which are the least fun, but also most important part for a lot of companies. This data might go into an annual ESG report. You might report to the CDP. You might have set or want to set science-based targets. And of course, the whole impetus of this conversation is reporting your emissions aligned to California's climate laws, so SB 253. After you've reported your emissions, the exciting part, I think anyways, is figuring out ways to improve your data quality and reduce your emissions. So using software at Carbonhound, we want to help you identify hotspots in your emissions as an organization and help you figure out ways to make the biggest impact across your organization using things like solar panel installs or different suppliers for different ingredients, thinking about where you purchase things from and how far they have to travel. And over time, and as your climate journey grows, we want to improve that data quality and again, look towards reducing your emissions. I'm going to pass the proverbial torch back over to Lisa and Susan to talk about third-party assurance, because even though you might do your greenhouse gas emissions inventory with a consultant or with software like Carbonhound, or even by yourself using an Excel spreadsheet, if you're using this data publicly, you might opt to, or you might be required to get somebody else to check your work.
Great. Thank you, Lauren. How is my sound, Yunji? We okay?
You sound great.
Great. Okay, so I'll pick up with third-party assurance. We'll take a bit of a deeper dive into this topic. The first type of third-party assurance, there's two major types, is limited assurance, which offers the client a bit of lower confidence in the assurance statement. As such, the assurance statement is negatively worded. For example, it might sound something like, we have found nothing to suggest material misstatements in this greenhouse gas inventory. Limited assurance is required, as we talked about earlier, for Scope 1 and 2 emissions under SB 253 and strongly encouraged also under SB 261. Then, starting in 2030, limited assurance will also be required for Scope 3 value chain emissions. Keep in mind that you may also need, as we talked about for SB 261, under Clause 5, which reads, limited assurance is required if a reporting entity publishes quantified climate data, i.e. GHG metrics, or claims, mitigation, or adaptation actions. And we'll circle back to that in a second. Procedures for limited assurance include sampling, spot checks, limited review of methods, boundaries, controls, and maintaining and checking error logs. Let's move on to reasonable assurance. So here we're looking at a more intense and longer assurance engagement. This offers a higher level of confidence for the client, and the assurance statement here is worded positively. For example, we find these disclosures to be materially correct. Reasonable assurance will be required starting in 2030 for scope 1 and 2 under SB 253. And the procedures here include comprehensive testing of data, controls put into place with sources, interviews, audit trails, and on-site checks. So for the first 3 years of these laws implementation, the state is asking for limited assurance, which is designed to look for anything that suggests material misstatement. If an audit team does not find material misstatements in the greenhouse gas inventory disclosures, they stand as is, and they are ready to submit to the California Air Resources Board. So to recap, SB 253 limited assurance is required for scope 1-2 emissions starting in 2026. And under SB 261, it's triggered if a company publishes quantified climate data or makes climate-related claims. Starting in 2030, limited assurance for scope 3 emissions is required. And also starting in 2030, the bar rises to reasonable assurance for scope 1 and 2, which is, of course, a more rigorous standard. Next slide. So CARB's comments on assurance in the workshop that we attended, the 3-hour workshop that we attended, and perhaps some of the attendees here were there as well last week on the 21st. They shared a slide that was very interesting, and they talked to how they're making assurance sector agnostic, meaning that you do not need to have a financial accounting firm conduct your greenhouse gas inventory assurance audit. So let's dive a little bit into some of the acceptable assurance frameworks that CARB is currently considering. Of course, the final regulations here are still pending. They are expected in November/December. And they are still taking public commentary for assurance. So if you do want to make a comment, you are more than welcome to through the CARB agency. So the first standard that they're looking at is ISO 14064-3, which we here at Blue Sky Climate are aligned with. And this is called the Specification for Guidance for the Verification and Validation of Greenhouse Gas Statements. This is an international global assurance standard that's used throughout the world. So a very strong assurance standard. And it comes from more of a science-based standpoint. The next standard that they are also encouraging is another international standard, ISAE 3000. Now, the note here is ISAE 3000 that is published by the IAASB is valid only through December 2026, and at that point will be replaced by IASB's new standard, ISA 5000, which will be called the General Requirements for Sustainability Assurance Engagements, effective December 2026. Additionally, CARB is stating that they will also recognize Accountability's AA1000 AS standard, which is a globally recognized methodology for assuring the quality of sustainability reporting. And finally, CARB is recognizing AICPA's audit procedures as part of their assurance framework and approved standards. So what they would like to see in the assurance process, regardless of which standard is being applied by your assurance provider, is that number one, the assurance is systematic in nature. It's evidence-based, meaning that nothing is based on assumptions, and that they must be supported, your claims, by actual documented evidence. Second, they're looking for independence. This means that to remain unbiased and objective in all conclusions, the consultant or carbon accounting company that may be helping you calculate your company's emissions or do your reporting cannot also verify its own work. Thirdly, the process has to be transparent and well documented. That means records, methodologies, and findings must be clear and maintained. And then finally, every assurance statement must explicitly confirm its impartiality, meaning that it states that there are no conflicts of interest between the third party verification body or assurance body and the company. So in summary, assurance must be systematic, independent, documented, and impartial. Next slide. A little more on the assurance process if you haven't heard enough. So you've probably heard about the types of assurance CARB has identified for the climate disclosure laws and how they apply to these different reporting requirements. But before we walk through the actual process and what a company can expect in assurance, it's very well worth noting that the process is similar for both limited and reasonable assurance. But the key difference is that limited assurance relies on a lower percentage of testing and data sampled, while reasonable assurance involves a much higher percentage of data sampled and more extensive testing. So a company can expect that limited assurance will take less time. However, it is very judicious to allocate a 3-month period for your assurance engagement, meaning you should have your emissions measured and ready for assurance. We recommend by no later than the end of the first quarter, which is March 2026 at the latest. So assurance processes start with the creating of data sampling and a data sampling plan. Verifiers select sample sites based on factors like location, size, and function. Then the verifier will examine a company's data controls and quality assurance processes, and in some cases, maybe even recalculate emissions to confirm accuracy and consistency in methodology. Next, the conformance and reporting phase is where verifiers identify any gaps or inconsistency in the data. Here, they'll request clarifications and supporting evidence, and if needed, review revised data. Sometimes calculations or boundaries need to be adjusted based on these findings, and a log of anything found and corrected is compiled here. And then finally, there is the verification findings report where the verifier/auditor delivers a full assurance report and issues the final assurance statement summarizing the scope, methods, and conclusions of the assurance engagement. So the key takeaway here is really that assurance isn't just a rubber stamp. It's a structured process of sampling, reviewing, and reporting that's designed to make sure emissions data is both accurate and reliable. And the bottom line is give yourself enough time to find an assurance provider and allocate this assurance process into your timelines. We're looking at 2025 greenhouse gas data here for SB 253. So this gives you a full 6 months to calculate your greenhouse gas 2025 data emissions and then get assurance. So lining your ducks up with your assurance provider is very important. Next slide. So let's take a quick look, circling back to SB 261, the climate-related financial risks law, stepping away from assurance for a bit. The first reporting deadline for the California climate laws is this law, and it is hard set in stone at January 1st, 2026. That is correct, January 1st. So after that, disclosures will be required every 2 years under SB 261. And we should note that CARB stated that this date is in statute, meaning that it's already law and there are no changes to the deadline. What's important to note here is that CARB has provided guidance that for the first disclosure, a reporting company can use their best available information, which could include, for SB 261, not 253, measuring greenhouse gas emissions. Remember talking about the climate risk report, which is a more qualitative report. This could include information from fiscal years 2023 and 2024 or 2024, and moving into what you have already for 2025. So SB 261 needs to follow specific climate risk framework. However, companies do have some flexibility here. For example, last week, CARB confirmed that reports can align with TCFD 2017 framework recommendations. That's the task force for climate-related disclosures, or IFRS Standard 2, which is a newer standard, which is in some respects taken over TCFD 2017. And this standard is a comparable framework, which is developed under a regulated exchange or government requirement. So regardless of the framework you choose, the report must cover the following 4 pillars. Your qualitative SB 261 report must cover your company's governance, its strategies on climate risk management, and your company's climate risk metrics and targets. So let's circle back to third-party assurance and how it relates to SB 261. If a company includes any quantified greenhouse gas data in their climate risk disclosures, reduction targets, voluntary mitigation commitments, etc., these statements must also be third-party verified through limited assurance. And importantly, both the TCFD and IFRS Standard 2 explicitly recommend including greenhouse gas emissions data in their reporting frameworks. So the answer is yes for fully proper SB 261 climate risk reports. You should also receive third-party assurance here. Now, we anticipate that CARB perhaps may be waiving this requirement in the first round of reporting due for this January 1st, 2026. But going forward, note that GHG calculations with assurance should be completed. We are not sure of their standpoint on this, so always it's best to report to the highest standard and not to take any chances. For climate risk report preparation, companies must describe their material climate-related financial risks. So in this first reporting year, CARB has stated that the climate scenario analysis and mitigation plans that are usually reported under these frameworks are optional for 2026. But we do believe they will become mandatory and increasingly important in later cycles. Finally, regarding submission, the report must be filed with CARB. They are putting up an online portal that should be available as of December 1st, and you will be posting to this portal. Also, importantly, it must be posted on your company's website for public access by January 1st, 2026. CARB has said they'll provide further instructions on the mechanics of the submission closer to the deadline and reference this by no later than early December. So, in summary, the takeaway here is that SB 261 is about telling your climate risk story, using global frameworks to do it, and publishing in a way that's both accessible to the regulators and to stakeholders and the public. Next slide. So let's take a look at some timelines. We'll start with 261. And here we can see that between August and September, or now, companies must focus on getting their foundations in place. So selecting a carbon accounting platform for calculating your emissions, or if you want to go it on a manual basis, then collecting and calculating for 261 2024 greenhouse gas emissions data. So this is scope 1 and 2 only for this very first reporting cycle that you'll need in your climate risk report. Then you'll want to map your governance roles, risks, and opportunities. If you choose to do a climate scenario analysis, this is where you would do it. And we do recommend moving forward with the climate scenario analysis to set a high standard for your organization and to be safe. Then you'll line up an assurance provider, especially if you're reporting clause 5. And again, under both of these frameworks, if it's not confusing enough, climate greenhouse gas data is required and at the most suggested for this first reporting 2026 year. So you're looking at quantified emissions calculations and your mitigation strategies here, which also will be reported under SB 253. Then in October and November, your focus should shift to drafting your report. And this is where companies should prepare SB 261 disclosures covering governance, strategy, climate risk management, and metrics and targets. Integrate the 2024 greenhouse gas data into their disclosures, run internal Q&As, and secure leadership and board executive review. Finally, in December, your task is to submit through your website, and then also submitting to the CARB portal that we mentioned earlier. And our recommendation is, of course, not to wait until January 1st to submit. So I'm sure we'll have plenty of questions, which we'll take in the Q&A. I have one more slide. We'll look at SB 253's timeline for disclosing your 253 emissions 2025 data. Next slide. Okay, so here the first thing you want to do is select and onboard a carbon accounting platform such as Carbonhound to start your 2025 greenhouse gas data collection. Note that you cannot use 2024 data for SB 253, which is tentatively scheduled with a deadline for June 30th, 2026. So Carbonhound can help you define and document all your relevant data sources. And the beauty of Carbonhound is that they immediately run a baseline year. So they use 2024 data for a baseline year, which you can apply to 261. And then they'll run your 2025 data starting in 2026, which you can apply for 253. Also, during our preparatory time, these months currently, you'll want to onboard all your staff that's responsible for data collection, maintain a system of structured documentation like invoices, bills, meter readings, logs, etc., in a shared workspace. And then as the calendar turns and you have your complete data from 2025, you'll want to go ahead and calculate your greenhouse gas emissions. You'll want to immediately select an assurance provider. We recommend doing this again early on as we anticipate, frankly, that there will not be enough qualified assurance providers to meet the initial reporting demand. So be ahead of this. And note that in addition to SB 261 reporting preparation, we at Blue Sky also do offer third-party assurance if we have not worked with you on any of the reporting elements. Also, during this time, you'll finalize your greenhouse gas inventory, implement any quality checks to ensure completeness and accuracy, and you should also consolidate your inventory into an audit-ready format. At that point in time, during April and through the end of June, you'll be finalizing your assurance, hopefully, and submitting your disclosure. So plan on at least 2 months for limited assurance in the time period to undergo this type of inventory audit. And then get executive and board approval of that final disclosure. And finally, prior to June 30th, as it stands now, our tentative date with CARB, and again, this is still taking public comments, so it could shift, but as it stands now, the date is June 30th, 2026. You'll submit your SB 253 greenhouse gas emissions report and assurance statement to the portal, while also publishing it on your own company's website by this June 30th deadline. So with all of that, and I know it's a lot, I'll hand it back over to Lauren and Yunji for a final poll, and then we'll move forward to our Q&A. Okay, it looks like we have our poll up. Lauren, did you want to go ahead and take this over?
Yep, you bet. All right. So here we have our first poll from the beginning of the chat. We just wanted to get an understanding of how familiar people were. It sounds like, about 3/4 of folks are kind of familiar. I've read a little, but kind of unsure if it even applies to my company. Hopefully that beginning of the chat really helped clear that up for folks in terms of eligibility, or not eligibility, but I guess where you sit. And also just having a look at, 25% of folks are not familiar at all. I've only heard bits and pieces. And And that is super fair. You know, the 200s have been thrown around quite a bit, and it's a lot of acronyms, and there's so many regulations that might be impacting your business, that I can totally understand not reading through the pages and pages and sitting through hours and hours of webinars and carb sessions to understand this. Yeah. Any other thoughts, Susan, from this?
I'm just actually not surprised at the resounding budgetary constraints and resourcing constraints. We hear this all the time.
Yeah. Yeah. Looking ahead, and in not my experience in talking to people, people in both compliance and sustainability are often fighting there is no budget for this roadblock, right? If it's a new regulation or if it's something that feels like nice to have, it's really hard to get budget. But I think helping people understand the potential risks of non-compliance or consequences of non-compliance can help those individuals push things through. Nice. So yeah, please feel free to kind of keep filling out that poll. Um, limited in-house expertise, that is super real as well. And as you've seen, it's hard to be an expert in something that has come so quickly, right? Things are really changing and there's a lot to catch up on. And if you are the compliance go-to at your company, totally understand not having the capacity to read up on this. Yeah, I'm also a little bit, we threw that, meeting the regulatory timeline in there because I think there's this, not misconception, but there's this idea that, oh, well, it's not till next year. I can just do it in a couple months before, right? Not really understanding the scope of work that's involved in figuring out your baseline, collecting all of the data, going through that assurance process, and actually having something that's ready for that deadline. The deadline exists because we want to give people enough time, or they want to give people enough time to be compliant. It's not a date to start thinking about it. It's a date to know that you have to be ready. Amazing. All right, so now we'd like to field some questions from folks who are still hanging on and have burning questions. And we've had quite a few come through the chat. So let's start with the first question. So the first question it's a great question. And I think this relates to companies meeting that threshold of compliance. So why are we focusing on revenue as a separator or indicator as opposed to annual spend? And I will pass that over to Lisa to respond to that question.
Great question. Thank you. And really, it's that we have on why CARB chose versus spend and is considered to be more clear. So spend can very, greatly
Lisa?
approach it.
Hi, Lisa. So sorry. I
Oh,
think we're
yeah.
having some difficulty with your microphone. Do you mind adjusting it and trying again?
Jump into 2 while I get my, and then I'll be right back.
Yeah, Susan, if you don't mind taking that one then, and then once Lisa's sound is sorted out, she can jump back in.
The revenue question, yes. Okay.
Yeah.
What we're understanding is because the initial approach from CARB, and this is not set in stone, this is just what we're understanding. I do want to qualify that, is they're taking a revenue approach versus a spend approach because they were looking at tax code. Is my audio okay?
You're good.
Okay, excellent. Okay, so aligning with the California tax code, and so that's always revenue based versus spend based. That may change, as we talked about earlier. They are taking public commentary, so if you're interested, I would definitely say to log on to the CARB site and add your thoughts. I believe the public commentary is going through at least the end of September.
Yeah, thanks for that.
Yeah, and I'll take the next question. I believe it was Gokay as well. Yes.
Yeah.
Okay, about limited and reasonable assurance. What happens if measurements of the data is incorrect? Yeah, which would naturally affect the reporting claims, etc. In such case, how is liability handled? And is there an opportunity to, I'm not seeing the rest of the question.
Yeah, to resubmit or to reevaluate the data without penalties.
This is an excellent question, which I don't believe the state agency has provided an answer to as of yet. But I can tell you that within the assurance process, material misstatements it's designed to catch them. Typically, within limited assurance, the testing doesn't exceed about 10% of a representative sample of your greenhouse gas data, the raw data I'm talking to. So that said, eh, there may be things that do slide with reasonable assurance, which will be going forward. Those things will be caught. So the assurance process is designed to correct misstatements. And during that process, you're recalculating and correcting your mistakes. So hopefully that the mistakes are not reported to the state. And as far as liability, we do not have any further information on that from the state.
Awesome. All right, and then we just have one last question before we wrap up here. And it is related to scope 3 emissions, which is it is a whole Pandora's box, as many people who might have attempted this before know. So again, just to recap, scope 3 is all of the emissions that happen outside of the four walls of your business. So your upstream and downstream business, everything you purchase and everything that you send out and everything else. So the question is, um, calculations are based on many assumptions that don't often reflect real values. What are your thoughts, and what can be done to improve the the quality and sort of the measurement of scope 3 emissions? So the reality is everybody is going to start with the data that they have available. And yes, there is a lot of assumptions that we're making, but we are doing our best to follow the greenhouse gas protocol and start with the data that you have. So if you have spend data, we're going to use spend, even though that's not necessarily the highest quality data. So in year one, maybe we start with spend in some categories and real usage data in other categories to get the best picture of where we're at right now. Over time, we start to increase the data quality by digging a little bit deeper and trying to get access to that real usage data. So maybe instead of spend in 2024, we're using kilograms or kilowatt hours in 2025. Totally understand that this is a real challenge, especially when you go to your supply chain and you're starting to say, oh, I purchase wheat from 100 different suppliers, right? Or farmers or growers. How am I supposed to get real data from each of those suppliers? Reality is, yes, we don't. We'll just use estimates to start, and we will, over time, look at your largest suppliers and try to improve the quality of data by focusing on those largest suppliers, and then again increasing over time. I apologize. It's probably not a super easy answer or straightforward answer because scope 3 is so complex, but that is why limited and reasonable assurance exists. And that's why organizations comply with regular frameworks like the Greenhouse Gas Protocol and get audited to make sure that they are in compliance with those protocols so that we are giving the best picture available with the data that exists.
Can I hop in on one more note here, Lauren?
Totally.
And something that I have found very, very helpful is to look at the technical guidance for scope 3 calculations from the Greenhouse Gas Protocol. It's a supplement guide. So just Google technical guidance scope 3, and it will pull up for you on the Greenhouse Gas Protocol website. It has these really helpful flowcharts for data collection that show you what's the most optimal to what's the least preferred, meaning activity data versus spend data in many cases, not for all categories, but it goes category by category. And I think that could really help an organization figure out the optimal data versus the less preferred data for each category of scope 3.
Yeah, that's really helpful. And you're right. There are really great resources available. So if you are tackling this by yourself, it takes a little bit of digging, but folks have really tried to make this available to kind of educate yourself. Okay, great. I think based on time, we'll have to cut off the questions there. But for everybody who has outstanding questions, would love for you to either send us an email. You can, reach us. We'll send our contact information afterwards, but at Carbonhound or Blue Sky Climate, depending on your particular, you know, topic of interest. I think we really just wanted to highlight that while this is an extremely impactful regulation that is going to have a real impact on so many businesses across the US, but more than that, globally, even doing business in California, there are resources that are available to make it accessible and approachable and not totally scary and totally, overwhelming. So whether it's folks like ourselves or Blue Sky Climate or other communities or other kind of professional networks of folks who are navigating this, there are resources available and we can be one of them. And we just really want to thank you for your time today. Thank you so much for joining us, and please stay in touch. We'll send all of these resources out afterwards. Appreciate it. Have a great day, everyone.